Thanks for joining us today on Market Call. I'm Marella Fernandez. Chris Blumas on the show. He's portfolio manager at Raymond James Investment Counsel. He'll take your questions on North American large caps. Here's how to reach us today. You can call us toll free at 1-855-326-6266. You can also send an email, marketcall@bnnbloomberg.ca. Chris, good to see you. Thanks for joining us today.
Hi, Marella. Thanks for having me.
So we had new job numbers released this week in the U.S. Based on the numbers, you think the Fed was right to cut the rate this month?
I do. I think, that was the one thing they alluded to into their commentary is the risk to the job market. And with the government shutdown, a lot of the data was lagging and wasn't available. And what you found out today that, unemployment, the picture had worsened pretty significantly. So it kind of gives them some justification for what they did.
Do you think from what you've seen with the job numbers October and November, that changes the path of the rate cuts for next year?
I'm not exactly sure of that because, with all of these monthly data points, what they typically do is they release it and then they adjust it over time. And, that's why I think you'd need, more of a sequence of it and then, a little bit more robustness in the different types of data because really it was the federal government layoffs or early packages that were accepted that really spiked the number. If that's more of a one-off event, then things will tick back down. If there's more things in the pipeline and it happens more in the private sector, you'll see that number tick up.
Okay, let's talk about changes to come next year. Markets had a pretty good year this year. Next year in the U.S., they have the One Big Beautiful Bill, which will take effect. What do you think the effect of that will be?
Well, the one effect, which, they've been clear and they've stated is that, government spending and government debt is going to increase very significantly. And I think this kind of plays into what the Fed is doing. And one thing that wasn't really highlighted or mentioned, a lot of times with the Fed rate announcement, people focus on what the rate is and the fact that they were going to cut. But, it was pretty significant. At the meeting before that, they announced that they were going to end their quantitative tightening on December 1st. And at this last meeting, they've announced it means quantitative tightening hasn't even been done for 1 month. And they've already started easing. And if you look at the magnitude of that easing, 25 to 30 billion a month and where that gets you to over the next 24 and 36 months, that's a pretty significant injection of liquidity into the markets. And
what do you think the effect of that will be in conjunction with the One Big Beautiful Bill?
Well, in conjunction, it will help essentially finance a portion of the government debt. And, even if they maintain their same ratio of debt to total assets, they still would need to be doing some easing just to maintain that ratio. Or if they don't, they're in fact actually tightening, indirectly tightening. So I think there's a huge mindset that they don't want to indirectly tighten. And so I think what you could look to at a minimum is that they're going to maintain kind of a similar ratio of debt to total assets. And I think that does bode well for liquidity in the markets. And if there are hiccups along the way, I think you can expect that those injections of liquidity would be turbocharged.
Okay, let's take a quick break. We will line up the first phone calls for Chris Blumas of Raymond James Investment Counsel. Again, he's taking your questions on North American large caps. Here's how to reach us today. We're back in a moment. Welcome back. Let's start with an email here from Sean, a question today for Chris. He says, hello, can you give me your opinion on the 5-year outlook for Loblaw and George Weston? Chris, is Loblaw a stock that you follow? If so, what is your forward look on the stock?
Yeah, it is one that I do follow. I mean, they've done exceptionally well over the last few years, and there's been a lot of things in the news about, food inflation and things like that. I think the real catalyst for them in terms of kind of unlocking their profitability was when they acquired Shoppers. That Loblaw's business combined with that Shoppers business has tended, to be very, very potent. And, they've grown dramatically. Profitability has improved. And this is a business that generates a significant amount of free cash flow. It's not one that I own. In my preference is Couche-Tard over Loblaw's, but it is a good business, fairly reasonable valuation, and you've got a free cash flow yield right now slightly north of 5%. I think for somebody, interested, if you have your heart set on Loblaw's, I think it's a reasonable investment. George Weston is a holding company that owns Loblaw's. I think when you get into kind of going up a level on a holding company, you introduce other variables. There could be a holding company discount, things like that. So my kind of rule of thumb is I tend to go closer to the source and avoid the holding companies. But George Weston is also buying Loblaw shares to kind of maintain or slightly increase their ownership.
Okay, I hope that works for Sean as he tries to figure out which way he's going. Let's go to Chris in Delta, BC. Hi, Chris.
Oh, good morning, Morella. Nice to speak with you again, Chris. Great to see you back. My question today is on Pembina Pipeline. It is my number one position holding, actually, in my portfolio at about 15%. It's a strong conviction play for me. I believe that they're the Cedar LNG, there's the long-term contracts with huge players, customers, Ovintiv. I see the long-term growth for this company and their product just to be so good that being able to compound a steady dividend player like Pembina in a good jurisdiction like Canada is a worthwhile investment. And I'm wondering if you would agree with that, and I'd appreciate your thoughts. Thank you so much. Have a great day.
Okay, thank you for the question. So 15% is where is what his stake is in Pembina. First of all, would you agree with sort of taking that much of a percentage in a company like this? And what do you think about the probability of it compounding?
Yeah, in terms of the weight, I mean, that's always a difficult kind of thing, right? Because when you have a really high weight position and it works, it's great. And when you have a high weight position and it doesn't work, that's tough for me to comment without knowing somebody's situation. But I would say, given, the background the caller provided, that Chris provided, he seems to know a lot about the company. And I think that helps mitigate some of the risk when you have a concentrated position. That you really need to know it well. Otherwise, you get hit by something. And I think this is a name that I like. It's not one that I own. I have owned it in the past. My preference in the space has been Enbridge. But when you kind of compare the two, Pembina has, as Chris alluded to, a really strong growth profile. So that's number one, a real big positive. And, in terms of the valuation that it's trading at, it's trading at quite a reasonable valuation. The payout ratio on the dividend is quite reasonable. So, there's not a lot of dividend risk there. It tends to trade at a bit of a discount relative to Enbridge, and the reason why is because they have a collection of midstream assets. Not everything has the same contracted profile as say, the pipeline, an oil or a gas pipeline. So that's why it gets a little bit of a discount. But, I think overall, what you're getting is a business that's trading, south of 10 times cash flow, a well-protected dividend and good growth. So I think, no problem with Pembina at all.
Okay. Let's move on then to Daniel. Daniel's in Markham, Ontario with a question. Hi, Daniel.
Hi, Marilla. Hi, Chris. Great host and guest as usual. My question is on Power Corporation. Do you own Power Corp? And what price would you buy it? Thank you for taking my call.
Okay, thank you for the question. Power Corp at 71.73 today. It's actually down a little bit on the day, but 55% up over the year. Would you be interested, Chris, where it is today?
I wouldn't, and this will go just back to the comments that I talked about with Loblaw. So with Power Corp, you're 2 levels removed from the operating assets. So the main assets of Power Corp are Great-West Life and IGM Financial. And those are owned in a holding company called Power Financial. And then there's one level up, which is Power Corp, which controls Power Financial. And I think when you go up and you deal with these holding companies, there's always a discount that the market's going to attribute to that. And, that introduces a variable that you can't control. The discount can widen or it can narrow. My preference is to get closer to the source. In terms of the ideal asset in the mix, to me, is Great-West Life. It's one that I do own in client profiles. It's not a buy today for me just because of valuation. Valuation in the life insurance space has come up dramatically. It's trading north of 12 times earnings. I think that's a little bit rich to play given the growth profile, but it is one that I do really like. And I think I would look to enter something like a Great-West versus a Power Financial or a Power Corp just because of those discounts.
When looking at valuations for Great-West, where would you start being interested?
I typically kind of triangulate my buy price right around 10 times earnings. That's kind of a function of the organic growth potential of the business. They have a really unique growth profile in mature markets. They've done really, really well in the U.S. They're doing well in Europe. But when you compare it to kind of a company that retains a little bit more of its cash flow or earnings in the growth profile there, this is one that I typically own as an income name. But within the income names, it does have one of the best growth profiles of an income name. But when you compare that growth profile to a growth company, it's just a little bit weaker.
Okay, let's take a quick break. We will be back with Chris Blumas of Raymond James Investment Counsel. He's taking your questions on North American large caps. Here's how to reach us. We're back in just a moment. Welcome back. Let's go to the phone lines. Elliot's on the line in Hamilton, Ontario. He has a question today for Chris. Hi, Elliot.
Good afternoon. On the back of slower foot traffic and declining renewal rates, Costco is down about 20%. I guess my question is the love on the street for this stock going to stem the tide in the mid-800s, or are the rationalists who see a 50 multiple going to crush this thing down to a multiple of 30, and the share price is going down another 50% from here?
Okay.
Your assessment, please, of COST.
Thank you for the question. Chris, where do you see Costco going? It's been, people who invest in Costco really like the model of the business. They think it's doing well. I know membership accounts for quite a bit of its revenue, which is a good thing because sales are on top of that. But when you look sort of down the line, what do you think about Costco?
Yeah, I think, your comments were kind of spot on. So if you separate the valuation of Costco and the business of Costco, there's not too many businesses that are better than Costco. It's a phenomenal, phenomenal business because it creates so much value for its customers. So I think in terms of a business, it's phenomenal. In terms of its growth potential, it's still expanding into new markets and has a really good growth profile. So I think there's nothing going wrong with the business. Actually, the business is actually performing exceptionally well because it's one of the few places people can go to with inflation to capture value. So you've seen, the same as you've seen, Costco, Dollarama, Walmart, all of their same source sales are just very, very robust because of their value proposition. So this is one, I think, in terms of a business, phenomenal. In terms of a valuation, okay, this is the tough part because you can find a great business and then you've got to value it. And I think, this is a business that's trading at 40 times earnings. If you look at the margin profile and the growth and kind of the cash flow profile of this business, that just seems too rich for me. And so, what your caller alluded to was, hey, is this going back down to 30 times earnings? I don't think it's going to get down there, but 35 times, like this to me, I just struggle with, this is a business that was 50 times earnings. It's kind of come down to 40. To me, I think at 40, it's still too rich. And I think what will give you a lot of success in an investment in Costco or an investment in anything is, you really need to get earnings growth and multiple expansion. If you can get those two things in an investment, those are kind of the twin engines of your compounding. And if you get earnings growth, but it's less than kind of expected, and the multiple contracts, you could have a zero. So, you're likely not to be hurt, but you're likely not going to do very well. And so I think this was one I would just be more disciplined on the valuation and watch and wait.
Okay. Let's move on then to Tony, who's calling in Toronto. Hi, Tony.
Well, hi, Chris. Your thoughts on, I have some money to invest in my TFSA. What do you think of Algonquin versus Bell Canada? Would you split the money, or do you have a strong preference for one over the other? Thanks.
Okay. So Algonquin Power versus BCE, which we remind people under the Bell Media brand, it's a parent of this company. Telecoms has been a pushed back space for most of the year. Where would you put some money in at this point between Algonquin Power and BCE?
So both of those names, I follow quite closely. I've owned both of them in the past. I don't own them today. So I think the quickest answer for your caller is I wouldn't invest in either. The reason being, just with BCE is just kind of the growth profile. And I think, in the top picks at the end of the show, I'll talk a little bit about Brookfield Infrastructure Partners. That's also an income name. And I think this is one where you get a very attractive valuation, but a much stronger growth profile. So I prefer something like that to the two income names, Algonquin or BCE.
Okay, and we'll take a look at that closer to the end of the show. Let's get to an email then from Maurice. He says, which of the two engineering firm stocks would you favor to buy at the moment? So Stantec or Atkins Realis. I think you have a happy holiday. Between the two, how do they compare?
So, in terms of the two that I follow the most closely are Stantec and WSP. And I've kind of gone back and forth between which one I prefer. They're both very well-run businesses. I don't follow Atkins Realis as much. That's the old SNC. In my mind, why I kind of focus on the other two is just I want pure engineering and construction. When new projects are a go and green lighted, the design and those types of things are the first phase. And so I think I like where the pure design firms are positioned, kind of in the infrastructure kind of spend cycle. And then because they're service businesses, they have very, very attractive profitability and cash flows. So between those two, I flip-flopped. Some days I like WSP more, other days I like Stantec more. I think I'd slightly lean a little bit more towards Stantec just because they're a little bit smaller and maybe there's a little bit less friction on the growth. But if you look at the valuations between Stantec and WSP, they're almost identical. If you look at the free cash flow yields, they're almost identical. And if you look at the growth profiles, the 3-year outlook for earnings, they're almost identical. So I think in this one, I would just go with Stantec just because of the size. And they have a little bit more room to kind of grow into.
Okay. Let's leave the block there. We are going to take another quick break. We will take a look at past picks from Chris when we come back. All right, time now to have a look at past picks from Chris Blumas from December 18th, 2024, so almost exactly a year ago. At the time, Chris, you picked Honeywell, HON, on the NASDAQ. It was 226.86 US at the time. It's actually down to 201.19 today, so a 6% drop return, a 4% total return drop. Is this a stock you still own? Did you get out of it? Do you remember what it was you liked about Honeywell at the time?
No, absolutely. And I think that the return on this one is a little bit misleading because what Honeywell, this is a special situation, and what they're undergoing is a kind of a breakup. And so Honeywell spinning into 3 independent businesses. Their applied materials business, they spun out earlier this year. So that's a 50, for every 4 shares of Honeywell that you owned, you got 1 share of Soltis at $50. So that's why there's a drop kind of in the stated share price. But when you factor in the Soltis share that you would receive, you're right around break even. And I think, what is on tap for kind of 2026 is they're going to spin out the aerospace business, and then you're going to have 3 independent businesses that are all going to have likely significantly higher multiples than the 20 times multiple that's put on Honeywell. So it is one that I do like. It is a special situation. There's lots of value still, and this one would still be a buy today.
Okay, good to know. Let's get to your next past pick. CP Kansas City, so the rails, CP on the TSX. It was 105.43 at the time, so again, December of last year. And now to 101.55, so 4% drop return and total return down 3%. The rails have struggled along with other transportation stocks. So I'm wondering if this is something you're holding on to and expect it to do better in 2026.
Yeah, so two answers for this. So this is one that I don't own. This is one that I did sell earlier this year, just on the back of kind of the uncertainty surrounding the tariffs. I think this is a phenomenal business, but the thesis of being kind of an integrated, North American railroad comes under a bit of threat with the tariffs. And so where that's really likely to impact the company was just through the kind of medium-term growth, which I thought, kind of deserved a re-rating. And so I thought, in terms of the valuation and the growth potential, it wasn't there. So it's one that I did sell earlier this year. Still quite constructive on the business on the very long term, but I think over the medium term, there's going to be a bit more friction.
Okay, good to know. Let's get to your last pick from last year, which was TD Bank, TD on the TSX, which has improved a lot since last year, of course, when it was hit by penalties in the U.S. So it was 74.80 last December, and it's now to 124.72. So 67% upside, a total return 72%. Did you trim on this one? Do you expect TD to gain even more? I know their assets are limited in the U.S.
Yeah, so I mean, this is one. I followed this business for a long time. I really do like the business. This is kind of a thing that happens, right? When sentiment turns on a name, and it tends to be a pile-on. People can't hold it. They sell it. There's a lot of indiscriminate selling. Index rebalance. They indiscriminately sell, and the valuation just gets annihilated. And so, to get a return like this on an income name, to me seems, very weird. But you have to take these opportunities when they come. And I think what I alluded to earlier in the show about earnings growth and multiple expansion, in this situation, you had a very, very low single-digit 8 times multiple, and you've gone up to 12.5 times. And so I think, the earnings have rebounded after they took their charges related to the U.S. anti-money laundering, and the multiple is re-rated. And I think that's the source of your return. So I have selectively trimmed. It hasn't been a wholesale trim. In specific situations, I've trimmed, but I still hold it, and I'm still quite constructive on TD over the long term.
Do you hold other banks as well? Is TD sort of part of your financial holdings?
Yeah, just TD and Bank of Nova Scotia. And I guess the strategy for me kind of within the bank space is I try to get earnings growth and multiple expansion. So I tend to adjust and rotate among, to capture value for clients.
Got it. Okay, let's take a quick break then. We'll line up some more phone calls and emails for Chris Blumas, Raymond James Investment Counsel. He's taking your questions on North American large caps. We're back in a moment. Welcome back to Market Call. Let's go back to the phone lines. Frank is on the line, and he's in Toronto. Hi, Frank.
Hi, Marilla. Good afternoon, Chris. My question is regarding TC Energy. I've owned it, and I still continue to own it. I was wondering if I should buy some more of it, or the spin-off, which happened a year or so ago, Southbow, if I should own that. Which one is more attractive, and which price either? Okay, thank you very much.
Okay, thank you for the question. Do you like the spinoff or do you like TC Energy, Chris?
My preference is TC. So TC has the gas assets, and the spinoff has the oil assets. And so really why they did that is they wanted to kind of capture, or maybe not capture a premium, but they wanted to lose a discount. Because in prior years there was a really big hate on for oil pipelines. Optically, people were fairly negative, and so that had hit the multiple. When you kind of flip that and you compare kind of the outlook for natural gas and the view towards natural gas, it's a lot more positive. So that's what the motivation for the spinoff was, is to kind of get independent companies with more fuller valuations. So in terms of TC, I do like it. In terms of like my kind of priority ranking in the space, my favorite's Enbridge, second is Pembina, and third is TC. In terms of the valuations within this space right now, the valuations are quite strong. So I think this is one, like I would just watch and wait. I wouldn't be so aggressive to come in here, because there could be some more volatility and you could get an opportunity to kind of pick it up a little bit lower. And like of the buckets that I tend to allocate to for clients, the income bucket, it's performed so well recently, and the valuations, there's about a third of the names that I follow are buys there. So it has the lowest amount of buys of kind of my core buckets that I follow. And I think that just kind of a testament to the outlook for interest rates. And, as interest rates, the outlook is for interest rates to go down, then these income names have been bid up a little bit in advance of that. So the valuations are a little bit rich. So I would just look for a little bit more volatility on the rate side, and for it to hit, TC, and then enter on a little bit more of a pullback.
Just out of curiosity, where would you be interested in TC?
So when we kind of talk about the multiples, for Enbridge, I tend to kind of go right around 10 times cash flow. For Pembina, I kind of do 9.5. There's a little bit of a discount there for those midstream assets, and then with TC, I kind of put it right in line there with Enbridge. I'd like to get it at around 10 times cash flow. It's trading a little bit north of 11 right now, so looking for a little bit of a discount there.
Okay. Let's move on then to an email from Charles, who says, is the TELUS dividend sustainable at the current rate? Lots of questions about dividends with telecoms this time this year, and they did make a decision about their dividend, and I guess some people are still questioning whether or not that was enough for TELUS, or whether they could expect more to come. What's your take on TELUS, and if that dividend is safe?
Yeah, so I think this is one, where TELUS, I thought they had done a really, really good job kind of communicating their message. I think what they were kind of trying to say is, and show people, is how committed they are to the dividend. Because when BCE showed you they weren't as committed to the dividend, the stock went down by a third. And I think they were trying to say, look, we're really committed to the dividend. We're going to maintain our string of increasing it. But the increase was very small. It was like less than 5%. It was a very token increase to kind of keep your continuous streak of increases going. And I think that was a little bit, I do applaud them for being on the side of the shareholder. A lot of people own these companies for the income. And so when a management team changes their mind and wants to be more of a growth-oriented company, and all your shareholders are owning it for income, you've got a mismatch. And that's going to turn over really quick. So I think TELUS has probably the strongest management team in the industry. They've done very, very well. The valuation has come down a lot. So I think it is one, that I would consider. I don't own it, and that's just because of the growth profile. But, I am more positive on TELUS than almost all of the other telecom.
Okay. Let's move on then to Joe, who is on the line. He's in Hampton, Ontario. Hi, Joe.
Yes. Good afternoon. Good afternoon, Chris. My call is with regards to Brookfield Renewables. Now, it seems to me that the majority of analysts are considering it as a strong buy. And so I've been chipping away at it on the dips. But that doesn't seem to be doing me any good. Can I have your comments on this particular security? Thank you so much. I'll hang up and listen to your answer.
Okay, thank you for the question. Brookfield Renewables at 26.85, down a little bit on the day. Can I just get your take on the space first before you dig into Brookfield Renewables?
Yeah, look, I'm, I guess, more positively predisposed to the space, right? There's a lot of demand, for renewable energy. There's a lot of demand for all energy, and renewable plays a role in that as well. And I think one of the big catalysts, kind of, for electricity generation has been data centers. The data centers that support the build out for artificial intelligence. So I am quite positive, kind of on the space. In terms of Brookfield Renewables, this is a name that I do like a lot. Like most of the Brookfield entities that are under the holding company, they're income vehicles. Brookfield Renewables is an income vehicle. They pay out a certain percentage of their earnings and cash flow to shareholders. So I think, looking for this type of a name to react to news or growth and things like that, it's less apt to do that just because it is an income name. Growth is a little bit, more sluggish. But it's a very, very well-run business, a global platform. It generates a massive amount of cash flow, and they're very, very good on allocating that. So if you look at the valuation, it's a little bit of a premium. It's a little bit north of 12 times cash flow. So when you compare it to kind of energy infrastructure assets that are trading at kind of a similar valuation, there really isn't a green premium right now. And in the past, there was a green premium that went away a couple of years ago. But it is one that I would just sit tight and keep doing what you're doing. Look to add on dips.
Okay, let's move on to another caller. Then Amin is in Thornhill, Ontario, with a question. Hi, Amin.
Hello, good afternoon. Thank you for taking my call, Chris and Memro. My question is on Meta. I'm a millennial, and I've noticed that for a few years I was not on Facebook, and then now I'm back on it. I notice a lot of my friends are back on it, and it seems like the ads and like the content is very relevant, and it's getting better and better all the time. Is this a good time to load up a little bit more on Meta, especially with the recent sell-off? Thank you.
Thank you for the question. And tech has been selling off, Chris, which Meta today's at $659.89. In the tech space, do you like Meta?
I do like Meta. I think it's a phenomenal business. It's not one that I own. Within the ad space, I own Google, right? And I've owned Google for a lot of years. That's my go-to name, at a certain valuation. So I think, like you alluded to earlier, these tech names, especially the larger cap tech names, have had a phenomenal run on the premise of what artificial intelligence will be in the future. And, it's too early to see how that will play out. But I think this is one that if you do own, I would just sit tight and let things play out. And then, there are going to be hiccups. There are going to be speed bumps along the way. I just think of over the last 4 years in tech, the volatility that's been there. When names were too rich and we couldn't invest in them, then, within a few months, markets are reacting faster and faster because of the prevalence of ETFs and algorithmic trading. And so I think you really want to take advantage of that when you can. So if you find a name like Meta that you do like, I think it has great business economics. It is kind of an essential technology name. I would just watch and wait for a little bit of a pullback, right? But it generates a great amount of free cash flow and has a really good financial structure.
All right, more of a pullback than it's already experiencing then. All right, we're going to take a quick break. Chris Blumas is with us today to answer your questions. We're back in just a moment. Welcome back, and thanks again for joining us. Let's go back to the phone lines. Al is on the line. He's in Manotick, Ontario. Hi, Al.
Good afternoon to you both. Chris, I'm calling in about a company you've already talked about it, so I think my question is largely answered. I want to know what your thoughts are about Google, Alphabet. It's done great this year, but it's fallen off a bit in the last 2 weeks. Price-earnings ratio is right around 30 now. What do you think? Thanks.
Okay, Chris, can you also speak largely to the concerns about tech that have dominated the last couple of months? People have been, I guess, trimming or pulling back on valuation concerns and AI build-out concerns. But do you have those same concerns? Do you see a rebound for tech next year?
I do have those concerns. I think, in terms of kind of actions that I've taken because of those concerns, I really go with an approach, buy right and if you buy right, the upside will take care of itself. And so this one for me, I absolutely love Google, Alphabet. I've been invested there for a large number of years. I thought it was a misunderstood business, antitrust overhang. There's a lot of hidden value in its non-core assets. That's starting to be realized, right? So I think, the valuation to me is more fairly valued today. This is a business that your caller alluded to. I think it's right around kind of 28 times adjusted earnings. Okay, is that massively expensive? No. But I think to me, it's still rich. So I own it. I haven't sold it. Would I buy it today? No. It's a hold for me. And I would look for a little bit more of a pullback. And I think you're going to get this because it's a massive amount of money that companies are outlaying to develop artificial intelligence. And we don't know what the return parameters. It's likely going to be infrastructure type returns. But for some of these, tech names that have built their name kind of generating software like returns, that's a different return profile. So, over the next, 5 to 8 years, as this plays out, there's going to be winners and losers. A lot of these big tech names gush tons of cash and they don't want to be losers. So they've, kind of gone all in. I think what Google has the absolute, in my mind, has one of the best platforms. They have the data. They have a massive, massive profitability and very attractive balance sheet. And they have the AI capabilities. And so I think, it's very, very well positioned. I think the market kind of came to that realization this year. And that's where you saw that multiple go from 18 to 28. Like that's a 10 times, bump in the multiple. And so that's why the stock's up so big. But I would just be patient here and I wouldn't chase this one.
Okay. Let's move on then to Mike, who is in Toronto. He's got a question as well. Hi, Mike.
Hi, I'd like to ask about Main Street Equity. A lot of analysts seem to like this one, but it's kind of underperformed this year. I know you've liked it in the past. What do you think of it here?
Okay, Chris, you still like Main Street?
Yeah, I love this one. This is one of the few small cap or mid cap names that I do follow. The reason why I follow it is it's such an exceptional compounder. And I think, that's obviously not lost on your caller. This one is going to be more volatile than almost anything because, if you look at how it's owned, the management team and particularly the CEO owns a massive amount of this, right? It would be kind of north of 40%. You look at the other institutions that are there, larger cap mutual fund managers. And so the thing is, liquidity, it's not hard, but liquidity, from time to time, a mutual fund would be in redemptions and they are kind of forced sellers. And so I think it's one that, you got to use that volatility in your favor and buy it when it's kind of come down. And then you have to just close your eyes and plug your nose as it has volatility kind of in the future. Because I think over the longer term, it will continue to be an exceptional compounder. It just reported results earlier this week. They've gone back onto the offensive in acquiring, units at not distressed, but attractive prices, which is going to enhance their return on capital. So it is one I do like. Its structure is also amazing. It's a corp, not a REIT, so it's not forced to pay out that cash flow. They can retain it and invest it at high rates of return, and it's trading around 17 times funds from operations. So a very reasonable multiple to pay for a great compounder.
Okay, that was for Mike. Let's get into Brian, who is in Toronto. He's got a question. Hi, Brian.
Hi there. Thank you for taking my call. My question's on Canadian natural resources. It follows oil very, very closely, and oil has been on a downtrend now for about a year and a half. I'm wondering, would you step in at this price, or do you see a a lower price ahead for CNQ and for oil for that matter. Thank you.
Okay, thank you for the question. Yeah, oil has been battered a lot this year. There are obviously concerns about oversupply in the market. I know people like CNQ. They think it's a solid company and it can operate well even at a lower price level. But would you put money in at this level? Would you wait and maybe hop in next year? What do you think?
No, absolutely. I like this one so much and would buy it here today. I think anywhere kind of below 44, 45 is a very, very attractive entry point. I think when you think about CNQ and you think about oil, I think you need to kind of separate the two, because it would actually be in your benefit if oil did worse, because CNQ is so financially strong. They operate so counter-cyclically. The lower oil goes, the more they'll consolidate and the more they'll come out a winner. So this is one that is, even if you look at oil price over the last couple of years and you look at CNQ over the last couple of years, the stock on CNQ has been fairly strong. You've got an 9.5% free cash flow yield. So I think it's a very, very attractive valuation. And I wouldn't worry so much, hey, what if oil turns down? Because if oil turns down, they'll take care of that for you. They'll buy competitors, they'll buy back shares. They're the most, of any of the oil companies, the larger cap ones, they have the highest insider ownership, and they operate in the most counter-cyclical fashion, and that will create tons of wealth for you over the long term.
Okay. We will leave it there for phone calls and emails, but when we come back, we will have Chris's new top picks. That's next. Join us tomorrow for Market Call. Brian Madden with us on the show. He's Chief Investment Officer from First Avenue Investment Counsel. He'll take your questions on North American equities. That's tomorrow. And time now for new top picks from Chris Blumas. We're going to start with Constellation Software, CSU on the TSX, which has some changes on the go that clearly people have been reacting to, investors have been reacting to. You'd pick it up here?
No, absolutely. I think this is one, a phenomenal compounder. Sentiment has kind of gone against Constellation over the short term. But I think over the long term, that will re-rate, and that's where you'll get that opportunity for earnings growth and multiple expansion. I think some of the news and things like that have kind of focused on the changes in the CEO, and I think this is a very, very decentralized business. I think that timing was kind of more unfortunate. I mean, the timing when people have health issues, they have health issues. The real kind of uncertainty, or what people were worried about, is more on the AI side, and with the vibe coding, would that make software companies come under more pressure? But the reality is these are the companies that are going to be using that capability to make their products better. And so, I'm quite constructive on Constellation at this price, and think it would be a great buy.
Okay, let's move on to your next topic, which is Brookfield Infrastructure, BIP.UN on the TSX. We talked about Brookfield Renewables during the show, but you like infrastructure for the play.
So I always like to have one income name for viewers. I know there's just demographically, there's a lot of people that depend on their investment portfolio for income. So I do like to have one income name for people. And I think this is one that, really, really attractively priced, but gives you a little bit of both. It gives you growth and income. And I think, its valuation is very, very similar to other income names. But the growth profile is significantly better. It has one of the best growth profiles of the names that I follow. And so I think this is one where, when someone is looking for income, the dividend yield is right around 5%, the price multiple, right around 10 times cash flow. You've got a robust growth platform. So it's one I think that's really attractive for people looking for income.
Will this company benefit from build out next year in Canada?
Well, I mean, they're global. They're into everything, right? And so in terms of, how they'll position themselves to benefit from infrastructure spending in Canada, it will likely be within the pipeline or midstream energy portion, but they also have a data center component as well. So this is one where, they have 4 kind of key segments. They'll likely be able to attract business in almost all of them.
Okay. Let's get to your third pick then, which is Abbott Labs, ABT, in New York. They do medical equipment, and healthcare has been coming sort of back online in the last half of the year. Why do you like Abbott?
So this is a company, they announced an acquisition, earlier this month. And, it looks like a really, really attractive diagnostic acquisition, but also an acquisition that would allow them to provide some targeted cancer treatments. And because, they had to pay up more for the acquisition, it's not going to be accretive for a few years out. So the stock, actually went down. And, the acquisition's north of $20 billion. They're financing it internally with, debt and cash flow. So, over the longer term, it's going to be accretive, and it gives them a new platform for growth. And I think when you look at the price multiple, it's a little bit more than 20 times. The organic growth sometimes gets masked because of their diagnostic testing business that boomed so big with COVID. When you look at the underlying businesses, it's high single-digit organic growth. So I don't think that multiple reflects the true growth of this business, and I think that's where there's a little bit of an arbitrage on that. So I think, valuation really, really attractive.
Got it, for Abbott Labs. All right, Chris, got to leave it there. I'm out of time, but thanks for your time. We'll see you soon.
Thank you very much, and happy holidays.
Same to you. And thank you for joining us today on Market Call. We'll see you back here tomorrow.